Thanks for coming. My name is Song Weishui. I'm the mobile mortgage advisor from Cibc. Some of you, we already know each other, but some is a new friend. I have an office here, so if you guys have any question in the future, just give me a call. We can make arrangement for the appointment. And today we will welcome Terry to give out the speech about how to working together to grow the business for both you guys and us. Terry? Terry is our senior consultant, so he's more experienced.
We speak 43 different languages, and we mirror the community that we service and that you service as well. So we could talk to your clients in their language of choice. We are the fastest growing financial institution in Canada in terms of the number of mortgage advisors that we have, and also our business. Our business is growing faster than any other financial institution. So we're very proud of the brand that we have and the footprint that we have in the marketplace. And we really value the relationship that we have with Home Life Landmark, and we thank you for the business that you refer to us. Song mentioned he has an office here, and at the end of my discussion, I'll talk to you about some of the things that he can do to help you grow your business. But what I'm going to talk about this morning is the market, the resale market in the GTA. I've got the numbers. They're just very recent for the month of October. So we'll talk about the market. I'll also talk about the impact of the Department of Finance regulation changes that were announced a week ago, and the impact that that's going to have on the resale market in the GTA. And then I'll just wrap it up, as I say, with some discussion on how we can help you grow your business and all the things that we can do to support you in the marketplace. So let's take a look at the market for the month of October. And the way this is set up is we've got MLS volume, average price, new construction, and new immigrants. Now in 2015, last year, in the GTA, we had 102,000 MLS sales. And that represented $63 billion in money exchanging hands on residential activity. This year, in the month of October, we had 9,768 sales, and that is a 17% increase over October of 2015. So far this year, we have 99,000 sales up to October, so we're just shy of 100,000 with 2 months to go in the year. And I forecast that we're going to hit probably about 116,000 sales this year, and that will be the best year on record. So then 2015 becomes the second best year on record. So very, very strong performance. On a year-to-date basis, the 99,000, that's 12% over the same period last year on a year-to-date basis. And if we hit 116,000 by December, that'll be a 14% increase over last year. So very, very solid year. Average prices right now in the GTA are 762,000. That's 21% higher than it was October last year. And do you know that the last 3 months, so this is October, September, and August, we've had price increases in excess of 20% every single month over the same period last year. Unheard of, unheard of. On a year-to-date basis, we're averaging 725, and I suspect at the end of the year we'll hit an average of 750, but our end point, so the actual end of December, December 31st, our average for that month will be about 775. And that's about a 15% increase over the same period, December of last year. So, volume, sales volume, increasing, average prices increasing higher than the sales volume. New construction, we forecast that we'll hit about 36,000 starts this year, and that's a little bit of a decline over last year. And the reason that the new construction starts are declining is because the developers in the condo scene are trying to sell off their inventory before they start to do a lot of new stuff. And the second thing is the availability of land in GTA is restricted. So that's, we're not seeing a lot of new construction in that area as well. We're seeing new construction east, west, and north in the suburban areas, and that's where most of the new stuff is happening, like detached, semi-detached town, and to some degree condos. And then we have a real good news story here in the GTA in new immigrants. And we are forecasting that we will have 60,000 newcomers to GTA this year. 60,000, that's the best year. That's 15% higher than last year. And we have seen in excess of 50,000 newcomers in GTA since way back into 1990. It's phenomenal, phenomenal. Now, let's go back about the MLS volume and talk about that. Of the let's say the 100,000 year to date, 53% of the purchasers are first-time homebuyers. 53%, huge. And the closer you get to the downtown core, that number goes up. So right downtown, first-time homebuyers represent about 60% of the market. As you move east, west, and north, the number goes down to about 47%. So, but still, I mean, 47% or 60%, the first-time buyers make up the majority of the market, and that's very, very, very powerful borrower-buyer segment. Now, when we talk to purchasers, 57% of them said that they plan on doing renovations within 2 years of buying their home. That's very high. And what you can do to help them is that if a purchaser is planning on doing renovations in 2 years, you could suggest to them that they do their mortgage purchase plus improvements so that they can get the money for their renovations with the mortgage up to $40,000 extra. And the average ticket price for the renovation project that they plan on doing is about $21,000. So very easily they could do their renovations with that $40,000 right at the time of closing and with their mortgage, and then they don't have to worry about borrowing 2 years down the road. And that's important because when interest rates are as low as they are, this is a good time to do those renovations. Yes?
Quick question. So 40,000. Does that include the purchase, maximum purchase price, minimum purchase price?
So it's, the way it works, it's 10% of the purchase price to a maximum of $40,000. So you can cap purchase plus improvements at $40,000, but it's actually 10% of the purchase price. So an $800,000 home, 10% is $80,000. The cap then would be $40,000. But when you think that the average renovation project is $21,000, it fits.
I don't know where you're getting 21,000 because average renovation is coming to maybe about 90, 100, 120,000 on a very small $600,000-700,000 homes.
So that information is based on a consumer survey that we did last year on the people that actually bought their home, and it was how much were they planning on spending, and it worked out to be an average of 21. Yes, there are projects out there that are $100,000. There are projects out there that might be $5,000 or $10,000 small renovations. But regardless, there is funding available for them to do it at the time of purchase. So, what are the considerations for our market? Well, employment growth in the GTA is very strong. We've got unemployment rate at 6.9%, probably the best in the country. And our employment growth this year has been about 2%, very, very solid. And we forecast that that situation is going to continue into 2017. Immigration, very, very strong. And it's employment and immigration that drives housing across Canada. So when you've got newcomers at the range of 60,000 in the GTA, now that's very, very strong for the housing market. Home price growth in GTA is a factor of low inventory and high demand. We have seen in 2016 many purchasers entering into the market that probably would have come in 2017, 2018, and 2019, but they're jumping into the market now for fear that interest rates are going to increase. That's why we have such a huge demand issue and, of course, a low inventory. The Canadian dollar supporting manufacturing and tourism. In the case of tourism, last year we had 9 million tourists come into the GTA. 9 million in 2015. And they spent $7 billion in our economy in GTA. That's phenomenal. So that tourism aspect, because of the low Canadian dollar, is going to continue. And Toronto is a very, very attractive place for tourists. Now, we've all heard about the Department of Finance regulation changes, and they are going to impact the market to some degree in November, more so in December and into 2017, and I'll talk about that in a few minutes. So there's the picture as of October of 2016. Now, this is how we classify resale markets across Canada, and CMHC actually does the market classifications based on the CMAs. Now, before I joined Cibc, I've been here for 1 year. I was many, many years with Canada Mortgage and Housing. So what we do when we classify resale markets, we look at prices, sales volume, sales as a percent of new listings, selling price to list price, and time on market in number of days. We look at these and we look at them collectively, not in isolation, and then we decide what type of market are we in. It's declining buyers, balanced sellers, and overheated. Now right now in Canada, 8 of the 10 provinces are in a balanced market situation. There's 2 provinces that are in a buyer's market situation. That's Newfoundland and New Brunswick, and they're challenged economically right now. Then you say, okay, let's look at the CMAs. There are 2 CMAs that are in seller's market territory, and that's GTA and GVA, Greater Vancouver. Now, with Greater Vancouver, we know that they, a couple of months ago, they implemented the investment tax for buyers in Vancouver. And that, some of the media are saying that has impacted sales in Vancouver. Not quite. Sales in Vancouver started to drop 4 months, 2 months prior to the implementation of that tax. So there hasn't been a significant change in the market in Vancouver because of that tax. And for those of the investors who still invest in the market out there, they're going to Victoria, and they're going to Kamloops, and they're going to Calgary. And we're seeing the activity there. But the market decline in Vancouver is not a result of this investment tax. It is a result of just the normal change in the marketplace. Now, GTA, are we going to see that tax? I don't think so. Very, very unlikely. In fact, the premier of the province said that they weren't going to consider it. They were going to look at other options. We don't know what those options are. But if you look at GTA, I mentioned we're in a seller's market. If you look at October sales, October we had 9,768 sales in GTA, that was a 17% increase. So if you look at sales volume and you follow it, you'll see that sales in a balanced market are growing. In a seller's market, they're increasing, and in an overheated market, they're peak. Well, I would suggest that sales in the GTA are at the peak range, so it's overheated. If you look at that, just that area in isolation. If you look at price range, in a balanced market, price increases are generally in line with inflation. In a seller's, it's higher than inflation, and in an overheated, it's off the scale. Well, when you see 21% increase year over year in prices, for GTA, we're in overheated territory. Then you look at sales as a percent of new listing, and that's the supply and demand ratio. And in GTA, we're at 72%. Anything above 75 is overheated. Now, we have markets here in the GTA that are beyond the 75%, like Durham Region. Durham Region is the hottest market in Canada. And their sales to new listings is at 82%, just phenomenal. And then you've got selling price to list price. In the GTA, we're at 103%. So we're at overheated situation when it comes to selling price to list price. And then time on market, we are in the GTA at 16 days. We're half of what it would be in a seller's market. We're in a panic situation. So 4 of the 5 categories are in overheated here in the GTA. So we're on the verge, sellers almost into overheated territory here in GTA. And that position or condition or state, when you hear the media, it sounds wonderful. But if you're a real estate agent, it's not wonderful. It's chaos, because you know better than anybody the multiple offers that you're dealing with now. You get 8, 9, 10, 18 multiple offers. Well, if you get 18 multiple offers, you're going to have 17 clients who end up being ticked off. And who are they ticked off at? Well, you guys, because they lost the house that they wanted. So you're in a tough spot. Ideally, here's where we want to be in a balanced market situation. This is where we want to be. And I think that the changes that the government have announced are going to move us closer to a balanced market. But in GTA, we're going to be seller's territory for a few years yet. And I'll explain that. Now, what we're also seeing is that typically market classification is based on census metropolitan areas. What we're going to see as a result of the changes in the government, we're going to see markets that are classified by tenure type or driven by tenure type. Tenure type is detached, semi-detached, townhomes, and condos. And for example, if you look at the condo market, condos actually had an increase in October of 28% in sales. That was the fastest growing tenure type of all housing stock. Condo price increase was 13%. That was the lowest price increase of all the tenure stock, which means that people are going to start to flock to the condo space, and that is going to continue to have strong sales, but it's going to start to drive condo prices up. And right now, condo prices in the GTA, the average is $429. So you're going to start to see, because they're the cheapest, you're going to start to see that increase because people are going to go into that market. The semi-detached in the GTA is now over $1 million. You're going to see that part of the market start to slow down and probably end up being more in a balanced territory where the condo market is going to be overheated. So that's what I mean about the tenure type is going to change the way we do market classification, because the housing stock is going to drive different scenarios in housing. So the inventory that we have in GTA right now is 1.2 months. What that means is that if we had no new listings come on the market, within 1.2 months, there would be no houses available to sell. And a balanced market situation, the inventory is 5 to 6 months. Right now in Vancouver, they're 8 months. Calgary is 6 months. Halifax is 13 months. And back in 2008, when we had the crisis in Miami, their inventory, housing inventory, was 36 months. And the higher the inventory, the lower the prices will increase, or the slower they will increase. So, do we see the market crashing? Absolutely not. We will have a soft landing as a result of the government changes. And I'll just explain that to you now. In 2017, we are forecasting MLS to hit 102 to 117,000 sales. I would suggest to you it's going to be closer to 102,000. And let's assume that that is the case. If we hit 102,000, that will be the second best year on record. So we're not into doom and gloom because of these changes. Average price will be $756 to $790. I suggest it's probably going to be closer to $780. So we're still going to see prices grow in the GTA. New construction, 35 to 44,000. We're going to see the composition of new construction change dramatically. We're going to start to see more condos, more semis, and more townhouses. And they're the lower cost housing types. And new immigrants will continue to be in excess of 60,000. In fact, the finance minister last week when he did his economic update, what he did say that was very interesting is that for newcomers, they are going to improve the visa processing time for low risk, high talent newcomers. That is very, very, very positive for the GTA. And I'll talk about that in a minute. So the consideration, our employment growth is going to continue, immigration is going to continue, and they drive housing. So that's good for GTA. Sellers market will prevail in GTA, but as I said, it's going to be more tenure type driven. Interest rates, and they're going to increase, and they're probably going to increase in the second quarter to third quarter of next year. Now we already know that the feds in the United States are going to increase their rates, so they say in December. We will not follow suit because our economy is much different than theirs right now. But rates are going to increase. And the impact of a quarter of a point in interest rates, we lose 40,000 first-time home buyers out of the Canadian market. That's 10%. So when rates increase, we will lose 10% of the first-time buyers in the GTA. And that could be 5,000 to 6,000 gone. Okay? But still, even if we lose 5,000 to 6,000 in the GTA, the market can withstand that and will stay in a seller's market situation. And the Department of Finance, the impact is going to be somewhere between 8 and 15%. And I want to explain this, how this works to you. So, there's three types of mortgage loan insurance. Now, mortgage loan insurance, the borrowers buy that from either Canada Mortgage and Housing, Genworth, or Canada Guarantee. So, mortgage loan insurance, there's three types. There's high ratio, and that's for the borrowers that can't come up with more than 20% of the down payment. So they have to, by law, take high ratio insurance through CMHCs, and the banks insist on that, and the borrower pays for that. So that's high ratio. Then there's low ratio transactional, and that's where a borrower may have more than 20% down payment, but the bank says, and we don't quite like the covenant or the property, we want to get that insured. So the borrower has to pay for that, even though it's a conventional mortgage. And the third one is portfolio insurance. And this is where banks, financial institutions, and the monoline lenders take their mortgage portfolio, they pool it together, and they obtain what we call portfolio insurance. That allows the banks to securitize and raise capital for future lending. When they portfolio insure, that portion of the portfolio is 100% government guaranteed. So there is no loss to the banks, okay? That's why the banks then can keep interest rates low, because the portfolio insured, there's zero risk. Now, on the high ratio insurance, the government with the recent changes said that if any high ratio business, we will not amortize anything greater than 25 years. So that's the maximum amortization. The second is the stress test. And that's where all borrowers have to qualify for the mortgage qualifying rate, which is what, 4.64? 4.64. So that means that even though they're going to get a 2% mortgage, they have to qualify at that rate. And if they don't qualify, then they don't get the mortgage. And the third thing is the properties over $1 million. Now, this isn't property value, this is it's the resale. So if a property is sold for more than $1 million, regardless of what the borrower puts down, you cannot get high ratio insurance. Okay? So there's the criteria now. Now this was in place on different products in the past. Now it's for all high ratio products, all terms and products. Now, low ratio, no change. Portfolio, now here's the kicker. What the government has said is that any banks that want a portfolio insure, these rules now apply. Right now, banks on conventional mortgages don't follow this. But if the bank wants to portfolio insure, these rules apply. And this is the real kicker in the regulation changes. So what it means, for example, last year CIBC did about $6 billion in portfolio insurance, okay? If CIBC wants to portfolio insure, that means they can still do it, but they have to start pulling out all those deals that are 25-year plus amortization, that don't fit that, and are less than $1 million. So they start picking those out, and they portfolio insure whatever is the rest. Now, the question is, will the banks then say, okay, we now have these rules for everybody? And so far, the banks in discussion with the Department of Finance, they're not going in that direction. So you won't see the banks leading this, but you may see OSFI say to the banks, you have to follow those guidelines. Isn't the case right now, but it remains to be seen. And if they do, that is going to have an impact on the market. The impact that this has primarily affects first-time buyers. The repeat buyers, they can pass the stress test, but this will affect first-time buyers probably to the range of 8 to 15% of the market. So it remains to be seen what this or this is going to do to the market if there's changes. Now the government Dominion Bond Rating Service did, before the regulations came out, they did a theoretical calculation, gross debt service calculation in Vancouver and in Toronto. And what they did is they said, okay, the average income in GTA and GVA, the average price and the average 5-year mortgage rate, what would the GDS calculation be? In Vancouver, the GDS calculation was 82%. What's our underwriters accepted for GDS?
33 for
33?
33 for GDS, 40 for GDS.
Yeah. So right now, in order to qualify for a mortgage, it's 34% GDS. And based on the calculation that they did in Vancouver, the GDS was 82%. So they did the test in Toronto, and Toronto was 50%. So very clearly, the government had to do something to protect consumers against the escalating debt and the impact of that. And then the other thing is, you know, since 2008, we've had 6 regulation changes. The most recent is just last week. The previous 5 were implemented to sort of get control of the market so that it doesn't go crazy, and none of them really worked. One of the recent ones was reducing the amortization down to 25 years and less. Well, last year, 58% of conventional business still had amortization in excess of 25 years. So the government said, well, that rule didn't work for us, so they had to come up with something else, and hence these further changes. However, having said all of that, I said earlier that this year in the GTA, we could quite possibly hit $82 billion. Now, remember, in 2015, we did $63 billion in MLS sales in GTA. 2016, I figure we're going to hit 80 to 82 billion. Okay? Now, this was the best year on record. This will be the best year on record. That moves to number 2. Now, let's assume that we hit $80 billion. And with the government changes, which could be 8 to 15, let's say the impact is 20%, which is really extreme, but let's say it's 20%. That will take out 16 billion of the market. And that leaves next year in the range of $64 billion, which is $1 billion than the previous best year on record. So even though the changes will have an impact on the market, our market is going to be very strong in GTA. And we'll probably be more into a low seller's market territory because of the changes. Now, let's say last year we did, or let's say this year, let's say we do 110,000 MLS sales, and we were impacted by, say, 10%. So that's 11,000. We're still going to be about 99,000 MLS sales. So a very strong year, only shy of a couple thousand from last year's best year. So is it going to impact the market? Yes. Who's it going to impact? First-time home buyers. They're going to be affected by the most, and it's going to be the fringe first-time buyers, not necessarily the newcomers. And I'm going to show you this. In Canada, we have seen in excess of 250,000 newcomers every year since back to 1990. This year, we will hit 300,000 in Canada. And the Department of Finance is saying they're going to make it easier for low-risk, high-talented newcomers. That is very positive for the market. Where are the newcomers going? British Columbia, Alberta, and the majority into Ontario. And they're coming from China, India, and the Philippines. And you know, just a few years ago in the last census, the majority of newcomers were coming from Europe. And that has completely changed now. And there are the 3 countries where we're receiving most of the newcomers. Now, 62% of newcomers settle in Toronto, Montreal, and Vancouver. In 2006 census, that number was 70%. So what that is suggesting is that the newcomers are still coming into the GTA, but they're moving outside into the east, the north, and the west because of affordability of housing. That's not a surprise, but still very strong in that they're coming into Toronto. 36% of the households own their home versus 70% non-immigrants. Now that's not surprising. What it suggests is that home ownership is important to newcomers, but in the 2006 census, that number was 30%. So it's showing a trend that newcomers are buying homes. They're coming to Canada with wealth that allows them to buy homes. Look at Oshawa. Oshawa has the highest percent of newcomers owning their homes, 70%. That's the highest in the country, actually. Sherbrooke, Quebec is second, but Oshawa, highest. So that just goes to show that they're starting to move towards the outlying GTA. This is the real kicker here. 41% of newcomers have university education. They're under 82% are under 45 years of age, and they have earning trajectory like this. Now the newcomers' earning trajectory goes like this. The non-immigrant earning trajectory goes like this. So these people that are coming to Canada now are young, they're educated, and they've got earning potential. And they will be into home ownership within 3 to 5 years of coming here. Versus the non-immigrant, it's 34 years. So there's your potential. There's your potential first-time buyers, and these are the folks that are going to continue to drive the market in the GTA. First-time buyers, newcomers to Canada. So, just to wrap it up, generally speaking, most Canadians feel that the housing industry and the mortgage industry are in good shape. In fact, all financial institutions have to do a stress test every year on their mortgage portfolio. And we look at hundreds of different catastrophic things that could possibly happen against our mortgage portfolio, and in every case, we pass. So our mortgage business is very solid, and it's in good shape. Canadians do have very high expectations of their realtors and of their mortgage professional, and they value a one-stop shop. So if you have a relationship with a mortgage professional like Songli, first of all, it's what the consumers want, but it allows you to control the purchase a lot better because you're working with somebody and you've got the mortgage financing in place and you've got control of the purchase, and it's nice and clean, and that's really what consumers are looking for. And then we have the different mortgage or market opportunities if you have a partnership with somebody, and I'll tell you what they are. Every year we get hundreds of thousands of inquiries into our website and our telephone banking center at Cibc. And the majority of those people are first-time buyers. We make every effort to ask those consumers before we send them off, refer them off, do you have a relationship with a realtor? And if the answer is no, when they send the file to Songwei, and it says they do not have a relationship, then he can go and refer that client to you. And that's the value of our partnership. The other thing is, in our branch network, we get about 5,000 clients through the branch every month. And they come in for pre-approvals. And when they come in for a pre-approval, if they don't have a relationship with a realtor, it's referred off, and then he will decide what realtor he wants to give that client to. So there's that. We also have Realtor Days in the branches. I don't know if you've seen our realtor boards in the branches where you can display your listings. So we'll have a Realtor Day where he will come in with you into a branch for a period of time, and you have the opportunity of talking to clients. Talk to them about their housing needs. And it's interesting because we're doing a lot of them right now. One we did at Yonge and Queen, We had one realtor partner up with the mortgage advisor, and they did 3 days over the month of September, different days each week. And the realtor who was in partnership came out of there with 100 leads. Now where that'll end up, I don't know, but the fact is he's got 100 potential clients for 3 days at about 2 hours a day, 6 hours worth of time, and he's got a potential of 100 leads. And that option of working in the branch with the mortgage advisor is available to those of you who have a relationship with him. Now I know this office has a relationship with Cibc, so that part should be pretty easy. For those clients that don't qualify for a traditional bank mortgage, they may be credit challenged. We have Home Loans Canada, which is a subsidiary of CIBC, and they will handle all of those deals. So we'll refer them to Home Loans Canada. That Home Loans will then work with the client to try to get them approval. Now our success rate with Home Loans Canada is about 42%. So that means 42% of the clients that are credit challenged end up getting approved. And that compares to the industry average of 28%. So we do a better job than the average. So there's that opportunity as well. We have the best realtor reward program in the industry. So if you're not signed up, you should be. The other thing that this insurance regulations, I talked about the portfolio insurance. What that portfolio insurance is doing to the monoline lenders is it's really choking them in the sense that they relied on portfolio insurance so that they could capitalize and then get further funding to go out and lend again. Well, with these regulations, the monoline lenders aren't going to be able to do that. And as a result of that, the brokers, mortgage brokers in the marketplace are going to shrink. They're going to disappear. And that's going to take the monolines out of business, and it's probably going to strengthen the business for large financial institutions. So that's going to have another impact in the marketplace. So there's lots of opportunities for you to work with us to help you grow your business, and I know Songwei would be pleased to discuss that with you one-on-one at any time. So that's the presentation. Do you have any questions? Yes. Sorry, come back to you.
These changes that we talked about, you said there was one week ago, and there's one coming in end of November.
Well, the one at the end of November is portfolio insurance. That's the one that hasn't been implemented yet. So that's the third one of the change.
What was the one that was a week ago?
So high ratio, so it's the stress test, maximum 25-year amortization, and no properties over $1 million. That's the one that was announced. The stress test, and then portfolio insurance, which really doesn't affect you or consumers to that degree. That's the one that's coming in November.
Yeah, in all your forecasts, have you discounted US elections results in that?
No. No. No, we haven't. It's basically status quo on the basis of our market situation, our conditions.
But their interest rate doesn't affect as much, right?
No. In fact, their rates are going to go up next month, ours aren't. So, yeah. Normally, in the past, for many years, we have always followed suit. When their rates went up or down, we followed suit, but that isn't the case this time. Yeah.
Well, really, to your point, if the rates do go up in states and they do remain the same here, dollar is going to go down, hence more people overseas might be wanting to buy here.
Yes.
But you raise a very interesting point. If the interest rates do go up, let's say in the next 2 quarters, 3 quarters, by quarter per point, and subsequent quarter maybe another quarter per point, that gives you half a point. Will that shrink the first-time buyers even more?
Mm-hmm. Yes, it will. However, I don't see that you're going to see a half a point increase in the next year. You may see a quarter point, half a point No, I don't think that's gonna happen. That would mean our economy would have to be growing like it leaps and bounds, and it isn't gonna happen. So quarter point, yes, we can withstand a quarter point. And even if it did go up a half a point, the interest rates on a historical basis would still be very, very low. Very, very low. But to your point, it will impact first-time buyers the most. Yes?
In case of disqualified clients, from the income point of view, what are the further requirements?
Well, I think if someone is, doesn't qualify, then they're probably gonna have to consider increasing their down payment or looking at a property that's a cheaper range that will match their income level. Or they just say, I'm out of the market for a while and I'll continue to rent. Yeah.
Does that mean if it is 65-35, they get it?
60, what's 65?
The down payment 35%.
Down payment of 35%?
Oh, no, that wouldn't have any, that has nothing to do with it. So you can have all the down payments you want. If you can't afford the monthly payments, you can't pay. And I'll give you an example. A few years ago, a bank lent to a client who, when they took the mortgage out, the client, on paper, could not afford it. Even though they had a 50% down payment, the client couldn't afford the payments. So when they went into default, and it went to the judge in the courts, the judge said to the bank, you lent this customer money on the basis that you knew full well he couldn't pay. Why did you lend him the money? The bank said, well, he had a big down payment. Judge says, case dismissed, bank, you lose your money. So, you know, you can have all the co-signers you want, you can have all the equity you want. If you can't make the payments, you can't get the mortgage, unfortunately for some.
So what's your prediction about the price range impact? Like, for example, houses below 1 million, between 1 and 2, 2 to 4, above 4, like which would be impacted the most?
So the
with the new
detached
regulations?
homes that are now in the $1 million plus range, I would suggest that they're going to probably have increases in line with inflation, 2.5, maybe 3%. The semis and the townhomes will probably be in the 10% range increase. Condos, you're going to see them going 15 to 20% range because people are going to flock to affordability, like more affordable homes. And because there's huge demand going in that direction, that's going to cause prices to increase.
What about the higher range prices, luxury houses and all that? Will they be impacted because the buyers are different?
They will be impacted, but you're going to see increases in the inflation rate range for anything over $1 million.
Over $1 million?
Yeah.
Because the average price is right now.
That's what the average price is.
Yeah.
Well, that's what the average price is for detached. And that's the 10-year type that's going to be affected the most in terms of price increase.
Mhm.
But still, when you're increasing at 2.5%, 3%, at least it's increasing. Okay, well, thank you very much.